After natural gas recently bottomed here at around $2.77, we've seen the formation of this symmetrical triangle in which we are still moving in. Concerning the visible range volume profile, you're currently seeing that natural gas is consolidating in this high volume area. And coinciding to that, we're also seeing that cumulative volume delta is currently trending higher here. And so that obviously could signal a bullish breakout here to the upside, but whether this is actually about to happen is what we are going to discuss in today's video. And so whether the upside or downside potential is actually higher here at natural gas right now, we have to take a look at the fundamentals, macroeconomics, and geopolitics. Concerning liquefied natural gas, we do see that in the last 14 months, a lot of it has actually been shipped from Qatar and the UAE to the Asian markets primarily. And also the European markets have been a bigger importer of natural gas coming from this Gulf region. However, we have to keep in mind that the American markets aren't really importers of the Gulf natural gas. And so that might be one of the reasons we haven't really seen those supply disruptions really impacting those American natural gas prices, because we've certainly seen those supply disruptions being reflected in the natural gas prices, for example, here in the European area and also in the Asian area. Now, to really understand what we're currently seeing happening here, we have to take a look at the broader picture. And so let's do that by taking a look at the weekly chart of natural gas and some really important indicators, some really important ratios. And so if you like this approach, don't hesitate to click the like button, subscribe, and also give us a nice comment down below, so you can just give us your opinion or just ask some questions if you have them. Thanks for your support. Now, as we've already discussed in the last few videos, we do have history repeat over and over again here at natural gas. We do tend to see those cycles. And those cycles seem to be primarily defined by certain behaviors of certain indicators. We have, for example, seen quite interesting divergences happening with natural gas and the copper to gold ratio, because we tend to see that natural gas prices tend to move higher before those crashes hit and before we've seen those tops building out here. But then primarily what we've seen happening is a massive sell-off. Those sell-offs have actually occurred after we've seen the gold to S&P ratio rally. Now, let's have a look at those correlations and exactly how history is always repeating. Here, for example, in the instance of 2008, we've seen the bubble forming out here of the great financial crisis. We've seen that natural gas prices have actually been moving higher. Coinciding, we've seen that the gold to S&P 500 ratio has also been moving higher. Now, why is that interesting? Well, when this ratio starts to rise significantly, that means that gold is outperforming the S&P 500. Because the S&P 500 is the denominator of this ratio, we tend to see this ratio rise. Now, that always coincided to those bubbles forming out, or to those last few rallies before we've seen tops forming out and a sell-off followed. And we have seen that over and over again. Sometimes it has been signaled by a real upwards rally. Sometimes it has been signaled by a decreasing bearish rally or a decreasing downward trend, for example here in 2013, but we've certainly always seen this transition to a weakening, to a less weakening or a stronger strengthening trend at this ratio. And primarily in those where we've seen those big sell-offs, we've seen those big upwards trends happening, as we've obviously seen people fleeing to safe haven assets. Now, you may ask, why aren't we currently seeing that happening? Well, we at Chronos believe that as this ratio is currently falling, we are obviously seeing currently big price disruptions happening to metals, as we've also predicted in the last few videos. And so, by the way, if you like to watch them, they are now linked in the top right corner. But what we are currently seeing to metals is just a big sell-off, right? And so this ratio is obviously falling. The S&P is also falling, but gold prices are currently falling harder. That is why this ratio is falling right now, as you are briefly seeing. Now, We have seen that throughout history, that actually happened. For example, here in '08, we've actually seen some minor downward trends, but in the long run, we believe that the S&P is certainly having some downside potential and certainly has some way to go to the downside. And so we believe this might be trending higher, as we have seen it actually trend higher after we've seen sell-offs occur here at natural gas also. Now, concerning the gold to silver ratio, we do have quite similar, but maybe even more important signals coming from this one, because this is the direct signal between a safe haven asset and a more risk on asset, right? And so when this ratio starts to rise, that is really a big recession or certainly a big correction signal. And we've seen that historically actually start to consolidate and already start to move higher a little bit before we've seen those disruptions to the upside coincide to the top here at natural gas. Now we've seen that also coincide to all of those tops here historically, and as we've seen that a big weakening trend at this ratio, and as we've reversed now, we do obviously see that coinciding to history. We are currently seeing it all coming together. We are seeing that the puzzle pieces are actually beautifully fitting together. As you can see, we are now actually sweeping the high. We are currently building out higher highs. We are certainly in a upwards trend, and actually that is exactly what we've predicted in the last few months. We believe strongly in this thesis that history is really repeating itself, and that you can really predict the future quite beautifully with that. And another example of that is beautifully here on the chart right now. You can see the copper to gold ratio. The copper to gold ratio, it is really important to understand this dynamic. Copper is obviously an industrial metal, so it tends to rise when you do have industrial activity being high. Now, gold on the other side is a more safe haven asset metal, and so tends to strengthen when we do see economic distress. Now, when gold actually starts to outperform the copper prices, that means that this ratio is falling. And that means we do have economic stress. We do have recession problems. We do have that actually coincide to those last few recessions that are marked by those red areas here on the chart. We've seen that actually signal the dot-com bubble. We've seen it signal the crash in '08. We've seen it signal the great financial crisis. And we've also seen it signal the COVID crash. And so whenever this ratio starts to move here to the downside, that historically marked those last few recessions. Now, as we've seen that ratio to decline for quite some time now, and it hasn't really reversed, we believe that as we're currently seeing this gold to S&P ratio that we've just discussed, as we're seeing this move to the upside as well, that historically really has had a hit rate of nearly 100% concerning the prediction of recessions. And so it really seems like all the puzzle pieces are currently sticking together beautifully. We're seeing that that we're currently just having history repeat once again. Now, obviously, we do have a convergence between those theses. We do have massive supply disruptions in the Middle East. That obviously would bring up the thesis that you do have higher natural gas prices soon. Now, we have formed this bottom here in the end of February, but we haven't really seen those supply disruptions lead to higher prices. Now, the question is, are we about to see a breakout out of this symmetrical structure happening here to the upside because of those supply disruptions, or are we about to see a breakout here to the downside because of the historical and empirical facts that we've just assessed? Now, we don't know, obviously, we do not know anything, but we can have a look at the possibilities, we can have a look at how it used to play out. And what we know is that we've seen oil prices and gas prices typically rally before we've seen those crashes. Now, it is also quite obvious. We do tend to see, obviously, those wars first lead to massive inflation, not only with concerning the CPI, but also oil prices and gas prices. And then ultimately, as the economy is obviously disrupted by that, we do tend to see the stock market crash, and we do tend to see a deflationary spiral, a deleveraging event. And whenever this is starting, this could happen next week, this could happen next month, this could happen in the end of the year, but we do believe it is certainly going to happen in 2026. We are quite sure about that because it really seems like the end stage of this liquidity cycle. And so, whenever this starts to happen, we are certainly seeing a deeper crash here at natural gas. Now, as we're seeing the war in the Middle East, we are quite concerned that this has certainly some bullish effect also on the American natural gas prices. And so we might see short-term bullish pressure regaining strength here. We are certainly believing that is possible. But concerning the next few months, we expect that this is about to reverse, and we expect to see a deeper sell-off here at natural gas. I hope you enjoyed the video. I hope you learned something. If you did, don't hesitate to hit the like button, subscribe, and also ask any questions or give us your opinion down in the comments. Thanks for your support. See you the next time. Bye bye.